Hello, it's Kristi Sullivan with Sullivan Financial Planning, not being able to pronounce my own name. Thanks for tuning in. This video is accompanying a short blog that I wrote about how to evaluate whether or not a rental property is an actual good investment as far as the rate of return goes. And I won't talk about it because you could read about it, but I just want to make the point that the more equity that you have tied up in a rental property, the higher your rents have to be in order, well, not necessarily your gross rent, but the higher your profit needs to be in order to achieve those good rates of return. So while your net profits, if you have a mortgage, are lower, so is the amount of money that you personally have tied up in equity in that investment to make a judgment call whether or not that particular money, not the money that you're borrowing, is earning for you like a comparable investment, or that if it's earning enough that it's worth what I would consider the brain damage of being a landlord. Not everybody considers being a landlord difficult, but for some people they do. The other thing is, if you read my blog, you'll notice that the example I gave did not include property management, which a lot of people who are going to be landlords would like to pay someone to find their tenants, vet them, make sure the property is being kept up, have someone to be called instead of you if something goes wrong with the property in the middle of the night or the middle of the day or whenever. So property management rates, this is not for Airbnbs in a mountain town, that's different, but for Denver, at least for long-term rentals, can be anywhere from like 8 to 10% typically of a year's rent. So that is another expense to take into account to decide whether or not your rental property is profitable at all or profitable enough for you to want to keep it as an investment. Anyway, a few rambling thoughts there about rental property. I hope that helps you. Have a great day.